All right, it is a new trading week, and Tesla is exploding up $23 or close to 10%. If you guys remember, I sold a put credit spread on Tesla for January 2024, 120 and 160. So I bought the 120 and then I sold the 160. Sold the 160 for 340 or 334 and bought the 120 at $94. Okay, so that gave me a net of 200 some dollars, 280, something like that. So this is a put credit spread. What that does is if the 160 put triggers and it blows past this 120 all the way down to 120, Tesla at 120, then I would only be on the hook for $4,000, and I think it only cost me $1,000 I had to put up for this trade. So very good ratio. But now look what happened. The 334 is now only worth 134 or only worth 198, and this 94 is only worth 61. So these have both depreciated based on the market going up. So what are my options now? What do I do? So let's take a look. So here was my initial trade. These bid and ask were different, but let's take a look and see what this trade was. Dismiss this, dismiss this. Okay, so I'm on the hook for nearly $4,000. And it only cost me, I think, $1,000 to get into this trade that they're going to hold. But now take a look. What I can do is I can tighten this. So what do I mean by tighten? Instead of going to 120, let me go to 130. See, it's only $20 difference. Remember, I sold it for 94, or I bought it for 94, and now it's trading at 60. But if I roll it, I can roll it to 130, and look what that does. It drops my max loss down by $1,000. And when the market goes up, that's an option that you have, is you can roll the puts because you can buy it back and sell a new one. So this one, what I'm going to do is I'm going to roll this. So I'm going to sell it and buy a new one. So create a rolling order. Automatically going to create a rolling order to February, but that's not what I'm going to do. What I'm going to do is I'm going to go to January again. January 2024. And I'm going to do it for 130. Now what that would do, I'm going to sell the 120 and buy the 130 put. And it's going to, what it's going to do is it's going to cost me $21. Now, would I pay $21 to lower my exposure by $1,000? Absolutely, I would. So let me create and send this. I'm now buying the 130 and selling the 120. It's going to be at a $20 loss, but that is fine because the overall trade will be better. So let me go ahead and do that vertical. All right, let me show you something else now. Let's take a look at what I could do with the other leg. So let's build strategy. Now I'm at the 130. My exposure now is only 3,000 instead of 4,000. But still, we're talking about way out of the money contracts. We got a few months left in the year. Do you really think that Tesla's going to go blow through 130 on the downside? Maybe if there was a nuclear war. Not sure. Let's take a look at this 165. Now the 165, let's say I sold the 165. Let's say I buy it back and I buy back the 160, sell the 165. Now what am I doing? I'm increasing my exposure by about $400, but I'm increasing my credit as well. So see how I have this buy and sell here? This doesn't trigger, I'm still at the 120. And then I just won't get the 130. But let's create a rolling order for this here. I'm going to buy back the 160 and I'm going to sell the 165. Boom. But instead of February, let's do it for January again. And I'll get a credit of $31. So let's confirm and send that. Now what I did was I got the 21, I paid out the $21. I'm getting a credit for $31, which is a net of $10, but I'm reducing my exposure by over $700. And I'm keeping the $10. So let's do this. And it's only going to cost me $153 additional. All right, so I got those 2 trades in. The vertical for the 160 went, but the vertical for the put that I bought did not. So I'm going to have to monitor that and make sure that goes through. Oh, it just went through. So I went from, I hate clicking back and forth. I went from this right here. Went from this right here, almost $4,000 exposure. I made $200 and some on the trade. I went from that to this is now at 130 and this is now at 165. I kept my 220 and now I lowered my exposure from almost 4,000 to now 33, and I kept an extra $10. That is how you roll when the market is up or when your stock goes up. Now I could do an entirely new one at the old marks and still receive it. So I'll do another one at 120 and 160 again. And that still will net me 133, and that's still way out of the money. And it'll cost me even less. It'll cost me like $800 to do this. They'll just hold $800 and I'll net 133. Or I could go the opposite way. Let's go even closer. Let's say I like the 150 and I can narrow it to 150 and 170, and it'll still give me over 100, and then my exposure is only 2,000. So you can, whatever you want your exposure to be, whatever you think the risk to reward is, just you could put that in and you could play with the numbers. Let's say I want to go 180. That'll net me almost 200, and I got a spread of 3,000 here. So yeah, high volume stocks like this that move has a lot of premiums, and you could do some cool things with spreads.